Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And obviously this week we need to focus on the war in Iran. On Saturday, the US and Israel military forces attacked Iran, and obviously that war has continued on into this morning, and if anything it appears that it is currently escalating. So we need to talk about some of the potential economic effects, particularly with regards to the oil price and what that may mean for South Africa's inflation rate, but also the impact on supply out of the Middle East and generally the disruption to financial markets. The national budget was delivered last week. We did a podcast immediately after that, so I'm not going to cover the national budget within this podcast. If you're interested, please have a look at the website. We've got quite a lot of material on the national budget, the good and bad of that. The other topic, just quickly, I think short topic but useful topic, is what's happening to South Africa's private sector credit demand. There seems to have been an acceleration in recent months, and that acceleration is now broadening out into the household sector. And so I think we need to put that a little bit in context. But at the moment, the focus is very much on the war in Iran and what that might mean for various elements of financial markets, and in particular, does that represent a significant upside risk to South Africa's inflation rate at a critical juncture? So let's start with a discussion on the war in Iran. On Saturday, the US and Israel military forces decided to attack Iran. I don't think people are going to be surprised by the timing of that attack. You could see the buildup of US military forces in the region for some time, and it looked to us that the negotiations weren't making much headway. What is unknown is how long is this going to last? What are the ultimate goals of the US and Israel military forces? In other words, what does victory look like, and is that victory achievable? The other unknown is this going to broaden out and include many more countries? Already many countries have come under attack, but are they themselves going to start to participate in the conflict directly? If that happens, this becomes a significant regional conflict. So right now there are substantial unknowns. So there are a couple of things we need to monitor. We need to monitor what this means for financial markets, and understandably there's been a move higher in some safe haven assets, particularly gold. I would suggest that the increase in the gold price at the moment is fairly muted, and that's probably because the gold price is already elevated. There's been an increase in the oil price. Again, I think that's understandable. You are disrupting the supply of oil through the Strait of Hormuz, and clearly shipping activity in that region is going to come under enormous pressure, and we need to monitor what that may mean to supply disruptions around the world. And we need to also be mindful of what that oil price could mean for things like South Africa's inflation rate and therefore the potential outlook for interest rates. Obviously, in terms of risk assets, there's been already some sell-off in some of the major equity markets, but I don't think that sell-off has been particularly pronounced, and I think largely predicted. In South Africa's case, it's a bit nuanced, because while you have seen some weakness in financial and industrial shares, there's also been some strength in some of the resource counters, and so it's not just simply a question of all assets come under pressure. There may be some assets that benefit from this type of conflict. The area that I want to focus on, though, a bit more specifically, is what this may mean for South Africa's inflation rate. And the reason I want to flag that is getting inflation down to the 3% target is a significant achievement so far. Inflation sits at 3.5%. The progress we've made so far, I think, has been exceptional. And clearly it's part of our ongoing macroeconomic reform policy that we've been introducing in this country. But if I look at where we sit with petrol inflation, with the oil price, there is a potential upside risk. Right now, the petrol inflation rate is about minus 10%, and that's incredibly low, and we know that that number has been subdued for some time. But what it does when you're at minus 10% is you create a very low base effect. And so if there were to be a spike in oil price or the currency weakness, then you've got some significant upside risk, and that is clearly manifesting now. At the moment, the under recovery on South Africa's petrol price is up at 75 cents a litre. And that was before the war in Iran started. So as things stand, we're facing a fairly hefty price increase going into the next couple of weeks, next couple of months. And so that has to be a concern. And now we've had a further increase in the oil price. If at the same time the currency comes under a bit of pressure, then we're looking at a meaningful escalation in a key component of our inflation basket. And given that it's off a low base, it's going to start to move up quite quickly. And clearly that can create some short-term upward pressure in South Africa's overall inflation rate. Now, I don't think that that is going to be so disastrous as to scupper or derail our efforts to achieve a 3% inflation outcome. I don't think we're talking about that type of event, but clearly it can come at a time when we're looking for the Reserve Bank to cut interest rates. And if the Reserve Bank sees that a key element of the inflation numbers starting to move up, then they may become even more hesitant to cut rates and become more conservative. And so the risk for us is that interest rates simply remain unchanged for a longer period of time, and we don't get the benefit in the short term of interest rates moving lower and therefore reducing the cost of capital. So I think it's a key event we're going to monitor, together with any sort of supply disruption coming out of the Middle East, and then obviously what this does for financial markets more generally. I think all of this is going to be largely determined by the extent of the war. By that I mean, how long does it last? Does it broaden out and start to include other participants? And does there seem to be a solution in sight? Is something realistic going to be put on the table that can end the conflict and result in some sort of sense of normalcy returning to the Middle East? So a lot of unknowns at this stage. More questions than answers, but it's a key massive event that we need to monitor if we need to understand what's going on in financial markets. The second topic is a quick discussion on the growth in South Africa's private sector credit. If I look at the numbers that came out for the month of January, the annual growth rate by private sector credit is now up at 8.8%. And if you think back to the beginning, or pretty much the first half of last year, that growth rate was, for the most part, less than 4%. Now, the initial increase in that credit growth was driven by the corporate sector, particularly the corporates investing in renewable energy projects. But in recent months, there has been a broadening out of the credit growth. And now, more recently, it's noticeable that household credit has started to increase. Now, on the face of it, I think that's encouraging. If I look at the bank's approach, most of the bank's approach to the granting of household credit last year, that was very conservative. Those growth rates were sitting at around about 3% with not much activity taking place. And in particular, there weren't many developments going on within the granting of mortgage credit. But in the last couple of months, there's been an acceleration up to 4% growth with a movement, a slight increase in the granting of mortgage credit. And the hope is that that can continue on. It doesn't mean that we want to see a massive increase in household credit growth and that the household sector becomes significantly more indebted, that ultimately leads to financial concerns. But I think South Africa's growth rate would be hugely boosted by the development of South Africa's residential property sector. That sector has been massively underdeveloped, underinvested in for quite some time. We know that we have a substantial housing market shortage, and I think if we could start to channel more money into the granting of residential mortgages, I think it would help with South Africa's growth rate and obviously help with the labor market and generally provide some confidence back into the economy. So for me, overall, it is an encouraging development. Obviously, it needs to be controlled, but for the moment, it is something that we are looking at from a positive perspective, and I would certainly hope to see that there's further granting of household credit over the coming months. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.